tear straight into it. Online retail. I'll just get rid of the chat so we don't get distracted. But you should all be on mute, and we'll check in via the chat throughout the session tonight as well. But a quick reminder that everybody's at different stages of their learning journey, but we like to encourage everybody. So if some of these concepts feel a little bit hard to understand, that's okay. You can come back, you can revisit this, hence why we're recording it, and you can come back and start to learn some of these things because they are so important, and we'll touch on why as well. But as always, we're massive fans of trying to encourage clients and business owners to take action. So don't just consume this, actually take some action off the back end of it, and we'll be asking for some of your actions. So take some notes as we go as well. And if you don't know, which I'm sure you probably do by now, otherwise you probably wouldn't have signed up, but my name is Luke and this is Phil, and we are the directors of Next Advisory. We've got a great client base of clients and businesses all around the country doing a range of things. And this is actually the second time I think that we've done the Managing Cash Flow webinar.
Yeah.
And we've changed it up a little bit for you tonight. And on our What's Next podcast, we're often talking about managing cash because it is very tricky for business owners to get their head around, and we'll look at some of the reasons why tonight, but it is fundamental to understand in your business. For us, we're about life-changing advice for aspirational business owners, so that is for us as well, not just helping our clients, but helping other business owners out there and trying to give them tools so that they can go further in business. And we know that this is one of those things that people really need to understand. So very quickly, we help business owners improve their business by helping them understand the things that they need to understand. Normally, when we're working with clients, they're either wanting more money, more time back in the day, they want to be happier in their business, they want to figure out how they can get to the next level. And those are the sorts of things that we help them tackle by building plans and then reversing back what it is that they actually need to do in order to do that. Now, before we start, just a couple of questions here. This will just help us shape some of the things that we will speak to later on in the webinar as well. But what is perfect when it comes to money and business? So what would you like to see in your business to reduce your worry about money? Or, so there's some questions to answer in the chat. Or what do you wish you knew about money in your business? Number 3, what do you get stuck with in terms of money in your business? So if you want to answer one of those in the chat, use the number that you're answering so that we can come back and have a bit of a look. Because what we'll do off the back end of this too is we'll actually record some podcasts based on some of the questions that you are asking or your responses to these. So if you want to put something into the chat, then feel free to do that. And you can see those there again. So basically, number 1, what would you like to see in your business to reduce your worry about money? Number 2, what do you wish you knew about money in your business? Or number 3, what do you get stuck with in terms of money in your business? So there's a couple there already. Number 1 from Alice, get ahead of debt. Awesome. Number 2, when and where to spend. Number 1, would like to know about timeframes in terms of tax so we can be prepared. We see that a bit. It's tax time at the moment. That's why we're laughing, because that's what we're doing with clients.
The first question was asked is, I put up there, ProvTech stung in our second year.
Yeah, ProvTech stung in our second year. Ouch. And next one is, want a clear, easy way to track and forecast cash flow. Awesome.
Yeah.
So just on that, now, one of the things that we noticed when we asked some questions to people registering, what are you using to track your cash flow? And a number of people said Xero. Now, Xero can sort of be used at a very high level to keep an eye on your cash, but not to the extent we're going to try and teach you tonight. So we don't just want you relying on Xero because it's not the be-all and end-all of cash flow forecasting. Now, simply as well, why is this important? Well, recently there's been some data from Centrix that say that liquidations of Kiwi companies are up 40% on September last year. Now, we know that a number of those are companies that are closing down because people don't want to trade through them anymore, so they're captured in those. There are e-commerce businesses that started up during the frothy pandemic conditions and people have gone, that's not my thing anymore, I'm going to go back to work. So it's not like 4 out of 10 businesses have gone under, but there are a number that are closing down. So it's critical to understand cash, and how it helps you is it can help you set objectives and achieve your ultimate goals, can help you define the full impact of a project, bringing on a staff member, providing warnings and giving you solutions, getting you thinking about solutions early. So a number of these slides tonight will be quite wordy, but the point of that is that you can come back and you can pause this and you can rewatch it and you can understand more about cash flow, because it is a very in-depth topic, but we want to give you some actionable tools tonight as well. So that's the how, and the key components of a forecast is basically, firstly, Phil, like why businesses are doing it, right?
Crystal ball gazing.
Yeah.
And I think touching back onto the earlier point around the responses that everyone gave around what software they use in Xero was the number one thing. Xero's historic, so it's not going to help you forecast. Admittedly, they do have a cash flow forecasting tool or feature in there somewhere. It's got its pros and its cons, but the key components around like why you're doing this is, what's going to happen in the future? How can we make sure or prevent something from happening? Because so much of what we're talking about here in terms of these questions that are being asked are just so common, particularly around the tax stuff. And it's pretty easy to be prepared when you've got the insight.
Yeah. So there's a little bit of a misconception that accountants are probably always in your data, keeping an eye on things and being really proactive and working out how much you can pull out of the business and what you're charging and what you should be charging and things like that. But majority of what we see is accountants are merely filing tax returns and doing sets of accounts, basically. Not everywhere, but that is a lot of what our industry does. So you need to then understand some of these things and understand what questions to ask. But key components of the forecast are why are you doing it, revenue modeling, expense modeling, debt or asset purchases. Those are often what catch people out. So they don't think about how much money is going to get sucked out of the business by buying assets. And we see this all the time with clients where they might just go and buy an asset, but it chews up a lot of the cash that they have sitting there. And then we say, oh, what about tax? Oh, okay, lads. Well, I didn't really think about it when doing that. I thought buying this asset was going to reduce my tax liability, but that's not exactly how it works. So you want to be thinking about your revenue going forward, your expenses, and then modeling in, are you paying down debt? Are you buying assets? What cash you might be coming into? Are you going to take on any loans if you're going to buy assets? So all of those things where cash is moving in and out of your business, you need to be factoring in.
The other thing I'd add in there, and there's a question, we might be jumping around a little bit, but where somebody asked what cash flow actually is, and accountants are really good at throwing jargon around and confusing the hell out of business owners, which is a little bit sloppy. But it's important to remember at the moment that when we're talking about cash flow or a forecast, it's not just the profit and loss. I think so many people think that when they're talking about a forecast, it's sales minus expenses equals a net profit. And you think, well, I'll forecast that out 3, 6, 12 months. That's not cash flow. Yes, it's going to represent some of the money that's coming in and some of the money that's going out in terms of the revenue and expense modeling here. But the key thing as to why your profit isn't going to match the cash that's ultimately in your bank account is the forecast. And most forecasting stuff that we see misses that last box, which is around debt or asset purchases. And the other one, which would come under debt, is tax payments. So just simply doing a profit and loss forecast is not the same as doing a cash flow forecast.
And we'll show you some examples of forecasts as well so that you can understand exactly what we're talking about. And maybe before we do that, what we'll do is just jump into Xero. So I'll move.
Oh, sorry, Jennifer, just seeing your last question. Xero has a budget manager that seems like an okay sort of cash flow forecaster. Is that not the case? So what I was just talking about there hopefully answers the question. Short answer, no, it's not, because it's only the P&L.
So what we'll show you to just explain that in a bit more detail is Xero. So just let us know in the chat, can you see us in Xero now? So this is a dummy ledger, a demo company that everybody has access to if they have Xero. Hopefully you can see that. Just let us know before we dive into that. Cool. So this is, your Xero, say you're using Xero. Now, if we show you your a profit and loss in this Xero demo company, this is obviously some fake data, but what it's going to show you is your sales and your revenue and your expenses, and therefore sales minus expenses equal your profit. So one thing that often trips business owners up is that when you invoice your revenue for the work that you've done, it's going to recognize it in the month that you do the work, but you might not receive the cash until December. So simply looking at a profit and loss doesn't give you a true reflection of the cash coming into the business or going out, as Phil just said. So let's say you did $15,000 worth of work in November, but you're not going to get paid that till December. That's where your profit and loss is going to show that income in November, but your cash flow forecast would show it coming in, the money physically coming in December. Now, a key thing to remember here too is that these are done exclusive of GST. So all of these costs are after GST. So that's one thing that you have to keep an eye out for as well. But this is where you want to come to have a look and see what expenses that you've had in the past to factor in what you may need to include in your cash flow forecast going forward as well. Now, as you can see in October, they had just about a break-even month profitability-wise because they had pretty high advertising, but some of that advertising might be prepaying some of the advertising for months going forward. So this is where it does pay to really know your numbers. So did you know that this profit and loss statement exists in Xero? And do you know what this means? If not, we can spend a little bit more time on it. But basically, this is what we're looking at throughout the year for our clients. This is what we're teaching our clients to look at so that they can understand what income they have and then what expenses they have as well. But a profit and loss will not show you your purchases of assets. It won't show you repayments of debt because those things are not an expense. They are a pay down of a liability or a purchase of an asset. So they're going to be on what's called your balance sheet. Alex says, if you change the settings from accrual to cash, does that make it closer to the actual cash flow? Yep, that's going to show you the cash going in and out. But most of you will be on what's called accrual basis. So that is the profit and loss. And again, like we could probably do an entire webinar on this at some stage, and maybe even get you to send in some of your profit and losses, and we'll strip off the company names and we'll try to talk to them so we can teach more people about what you're looking at when you have a look at your profit and loss. But if you're not looking at this every month, well, there's your first action item. That is, one, I need to be looking at my profit and loss, because this tells you ultimately whether you're going to run out of money because you're not going to collect your profit, and the profit is what drives your business. So hopefully, all going well, all of this money would be received and you'll be paying these expenses and you're going to be left with some profit. And that's how we start to figure out how much tax you'd have to pay as well. Right, so we will just jump back in here and show you, firstly, our very simple monthly cash flow forecast. Now, we want to emphasize tonight that we've got some templates and our clients like them to get started. We encourage clients to outgrow them, to try and figure out how they'd like to do it, but to make sure that it's right so that all cash incoming and outgoing is in there. And some people like to do it on a very simple monthly basis. And I might just reload that. And I've put a copy of this into the chat. So if you want to jump in here and make a copy of this, you can do that. I'll send it out after as well, most probably tomorrow. But that is available for you and you can use that. But to carry on what we're talking about, this is basically where you would model in your sales and any other revenue that you've got, any incoming loan amounts, and that's going to tally up for you month to month. What money do you actually have coming in? So back to Xero before, when we had that $15,000 of income that we've invoiced out in November, we'd want to be putting that in the December column that's coming in. Now you can change the date of this, so you can do it month to month. If we change it to December, the first month will be December. So for instance, you would be putting, right, we're going to have $15,000 of sales cash coming in. Now, then you want to go through and you want to add in all the different expenses that you have in your business, and all of this can be edited. So again, make a copy by going to File, make a copy, download, whatever you'd like to do. And then you need to change this for the expenses that you have in your business. And then we get into the tricky bits, and that's basically what other cash payments are we going to have? So are we going to buy assets? Well, yes, we've got some of those modeled in there as an example. And then are you going to make loan repayments? What loans do you have at the moment? Are you going to draw money out yourself? Because remember, when you draw money out, that's taking cash out of the business. Entertainment expenses, and then tax payments as well. So factoring in the tax payments that you have to pay based on what your accountant is hopefully telling you. And then sometimes clients will go to the level of trying to calculate what tax they may have, so they can factor in paying some of that in May, August, and then January as well. So at a high level, those are the things that you want to be thinking about. Now, we often say when you're first doing this, don't do this 9 months here. Just simply focus on the next few months so that you can get a better feel for what money you've got coming in. Because usually when businesses start going past month 3, unless they're a bit more sophisticated, they're really guessing, aren't they?
Yeah.
And that's where it can become too confusing, because you think, well, I don't know what we're going to collect in March. What's the point of even doing this? But you might just want to keep it simple to historically what your revenue has been like, and then start to map in some of your tax payments as well. Now, of course, you need the opening bank balance that you have as well, because you can lean on that opening bank balance should you need it. Now, what it's doing is it's working out for us, okay, so if we have all of this income in here, and then we have this money going out, then what is going to happen to our bank balance? And so that's calculating it on a rolling month-to-month balance down here. Now, how this becomes really applicable is that recently we had a client who wanted to employ their first staff member. So for them, we changed other to employee, for instance, and we worked out what that was going to cost. And let's say it was going to cost them $6,000 a month. And we could easily basically just drag that out and see, okay, what's that going to do for us? Now, we're going to start to run out of money down here, as you can see, but they knew that that was going to lead to, by bringing on that employee, that was probably going to lead to about $10,000 of income, of cash coming in each of those months. So we could then forecast that out, and they could quite clearly see, well, actually, if that's the case, I really don't have too much to worry about, because my bank balance is going to continue to increase. So that's an example of scenario planning an employee, for an example, but you'll have your own reasons to do this. And it might be around buying an asset, for instance, and then paying down that loan. Now, often as well, people will buy a big asset and then they will actually get a loan for it. So they might take a loan of $30,000, which is effectively money coming in, but then they will buy an asset of that same $30,000. So it sort of nets in and nets out. However, then they're going to have loan repayments to pay down that loan. So that's the key thing not to forget when it comes to that. You could write some notes as well in here as you go, and basically keep a track of how you're doing this. And it's designed to not be perfect to start with, but give you a good baseline. And then as you go forward, you can start to get it more and more accurate. Now, again, the key is to actually do it monthly. So you want to set a calendar reminder and come back and update it for the things that you now know that you didn't know a month ago. Now, I've prepared this GST exclusive so that the payment for GST isn't factored in, but you need to be mindful of how you do your cash flow forecast of when you're going to be paying GST. and then potentially adding that into one of these lines here to include.
Coming back to an overall comment, I think one thing that is quite common for a lot of business owners is accounting seems to be scary. And I mean, for us, it's obviously not, because we're nerds. And with that, numbers then become scary, and that is then a barrier to doing this. And the common comment that we make to our clients or business owners is, don't overthink or overcomplicate this. Near enough is good enough. Cash flow forecasting is never, ever going to be 100% accurate. We like to say to clients, near enough is good enough. If you're 80% accurate, brilliant. The main thing that we're trying to achieve is two things, really. Looking at it and going, is there any cash flow issues that we should be concerned about in the immediate coming months, in terms of, are we going to have enough money to be able to pay the bills? And if you don't, then what are some of the levers that we can play with in terms of either deferring tax or collecting cash faster? And then secondly, the scenario planning that Luke was talking about before. So hiring a new staff member, buying an asset, getting a loan, adding in loan repayments, all that kind of stuff. So don't overthink it, just get started. And whatever your accounting software is, whether it's Xero, MYOB, or any of the other providers that are out there, use your P&L and your previous month's transactions to get insight to what the future could look like, because business is generally repetitive. Typically, you pay the same wages every month, you pay the same rent every month, the bank fees are typically the same, all of that stuff. So you just need to look at your P&L, drop that stuff in there. And the sales piece, a lot of people get stumbled on that. Near enough's good enough. You know your business better than anyone else. You'll know that in the holiday season, your business is either going to go really well because you're an ice cream vendor and you're out there absolutely hustling and you're having your biggest time, or it's retail, everyone's gone to the beach and no one's going to go shopping unless it's the Boxing Day sales. So there's those different things. You just got to model it up. We've done this with clients where we forecast it out using the spreadsheet, and there's some pretty grunty organizations that use this. It doesn't matter whether you're big or small. And the business owner said to us, hey, look, our sales aren't tracking as well as we thought they would. What would happen to our cash flow if we modeled a 30% reduction in our sales? We just tweaked a 30% adjustment to the top line just to show what that would do and how long that cash flow runway would be. And it's just so powerful to go, oh, gee, this is what we need to be aware of. So don't overthink it, just get started.
Nice. Rich has asked, is there a three-way forecast model?
Yes.
We can get to that. So, sorry, I thought I'd left the links to this in the chat, but I had sent them to the panelists and the host. I was basically sending them to myself. So a bit of a battler tech moment there. But I've just included this link to start with. But this is a very simple model to get you started and can really help you get your head around cash flow planning early on. Now, the second one that we have is a little bit more in depth. Now, this is week to week and requires a fair bit more input because you are trying to map your cash week to week. Now, you may not need to go to this level of detail, but some businesses do, don't they?
Yeah.
And especially businesses where they know that they have differing levels of income week to week. So let's say it could be a cleaning business, for instance, or a business where they're going in, they're doing things in 1 week, and then the next week they're not as busy, etc. But this has got as well an actual, so you can start to add in what you expect to come in, what you expect to go out, but then what actually went out. Now, Phil built this beauty, and there's actually a help section at the start here where you'll add in what your bank balances are as well, but there's some instructions. So the other one is a little bit more figure it out for yourself and just get started and play around with it if you like Excel. This has got some instructions, but it will also graph out what your forecasted balance of cash is going to be as well. And then if you've got an overdraft that you would have keyed in here, then it's going to show you whether you're going to go into your overdraft.
The other thing I'd add there, it doesn't have to be week. It's just 12 period. I think it's 12. You could make it 12 weeks, 12 months, 12 fortnights, what have you. So it's just 12 periods and just expected versus actual with a graph.
So this one as well has got GST payments. So you want to factor in your GST payments. But again, you've got to make a decision of how you're going to do that side of things. But some of these examples here should get you thinking about, you know, what things you've got going out of your business. But we showed you how to check that in Xero before too. Now, I think it was Abby who asked, is the number in the opening bank balance the total number of cash in all of our bank accounts? Yes. I mean, it's great that you've got separate accounts for tax, GST, etc. But back here, really, like if you had, say, $50,000 because you had $10,000 in your current account, but then you had another $40,000 set aside for tax, you would be modeling your $50,000 because you're then going to model out, okay, I'm probably going to pay $15,000 of tax there. I know that I have to, and I think that's August there, so there's some there. So that's how you'd be doing it. You would be factoring in the fact that you've got that money sitting there. Otherwise, if you modeled your tax but didn't increase your opening bank balance, you're not really reflecting the true ammunition or store of cash that you've got, and you might get a bit of a fright if you model in the tax payments and your your bank balance is going under. So there's two forecasts there, and you can make a copy of either of those if you would like. I'll put a link into this one as well, and you can easily change the dates and things like that. But again, just go to File and make a copy or download and start to play around with them. So with that overview of those two, do those feel like something you think you could make your own, or do they still seem too complicated? We'd love to have your feedback. And I guess secondly, what is it that stops you from doing something like this? Ren says it looks primo, it looks good, awesome, cool. I'm excited to work with these, good stuff. You know, like Phil said before, just get started and don't worry about it being perfect. Worry about getting it more accurate as you go, because there's always something that pops up. You know, we've got transport businesses, and whack, you get a $8,000 repair bill to a a truck in 1 month, but you'd be modeling it out that on average it might be $4,000 a month. But no, bang, this month we know that there's an $8,000 bill because the unexpected did happen as such.
I think the other thing, you just touched on it before, that when you're doing cash flow forecasting, this isn't set and forget. Luke did mention setting calendar reminders, and that is important. If you're going to be doing this monthly, set the calendar reminder, and it needs to be updated every single month, because obviously what you're forecasting is a guess. Near enough's good enough. It's not going to be accurate. You're going to need to remodel it for the next month for what's going to happen in the months 2, 3, and 4 in front of you. So it's important that you just don't do it the once and then think, oh yeah, everything's looking rosy. Businesses, as we all know, are constantly evolving beast, and things change, priorities change, and you're going to need to go, right, I want to do this asset. I want to buy my new Ford Ranger. What's that going to do to my cash flow?
Nice. Yeah, even this time of year, and I'm sure we'll get to it, but we have some clients where their sales will just decrease massively because they just can't go and do the services that they would normally do because people are away and their staff are on holiday, but their wages are still going out, but their revenue drops. So we need to make sure that by the time they get to that time of the year, they've got a healthy cash balance so that they can lean on that to get them through these couple of months where their sales are a lot quieter than what they normally are. Now, remember too that they might come back in full swing in February, but they might not get paid until March. So then there's that lag as well. Should you keep records of past periods to look back on to learn for the same period next year? Yeah, it can't hurt to, and you can easily, as an example, make a copy of this sheet if you wanted to, and you could change it to the actuals once they've gone by, or you could use the other version and keep an eye on it, and basically then come back and see, right, what things did we have to jog your memory? But usually we find that a business owner will get burnt once by cash flow at a time of the year, and they will go, they'll park that lesson. So as an example, that client who needs to lean on their cash over summer, it took them to go through a summer to pay out all those wages and then not have any money coming in to go, holy shit, I'm not going to let that happen again. Do you add in a savings column? I mean, you could if you wanted to add in that you were saving money, but what are you saving for? Are you keeping it in the business? Are you drawing it out of the business? Like, where is that going to? And that might be the piece for you to think about there.
Brock's asked a good question. Yes, there is a report called a cash flow summary, I believe.
This ledger might have it for us to show you.
Cash summary, I think. Is it that one? Under business performance? Not the statement of cash flow, that cash summary there.
Where have I missed it? Oh, there.
Yeah, I think. The statement of cash flows does as well, but it's very summarized. Whereas this one, cash summary, if you do it and then compare it to actual previous months, I think this is it.
Let's move my Zoom. 3 months.
Yeah, Amanda, that's so common that people get into the budget manager, which is just P&L, and the amount of times we see people going, well, why don't we have cash? Because they're forgetting about the balance sheet, which is all that stuff under the other movements. So you got fixed assets, GST, and if the business had paid income tax or provisional tax in one of those periods, it'd be in there, as well as loan payments. So that's the real critical stuff that always gets missed.
Yeah. But yeah, you might want to use one of those models to get you started. But Xero does have some good data that you can lean on to help you get your information even more accurate.
If you've got those templates there and you don't like them, we won't be offended.
No.
The other way to get started would be to download that cash summary from Xero, download it for the last 12 months, download it as an Excel, and then add on another 3 months, 4 months, whatever you want to do, and then just roll it forward. Go, right, what's my opening bank balance? Add in some formulas. One minus the other is going to equal a movement. Then what's the new opening balance? Just to get started. And at least that in that format there is pretty much our spreadsheet, except missing a few ins and outs, and it breaks down to GST a little bit more. But play with it. Just get started. That's the real critical thing.
There's just a couple of questions on savings, so I'll just touch on that a bit before we carry on. But say because I don't know what you mean by savings. Like, it could be that you want to save money and take it out of the business, so that would go under drawings, for instance, but you know that you've got it parked there if you were to need to reintroduce it to the business. Or it could be that you mean simply parking it into a separate bank account. Now, if you want to do that, if you've got savings for tax and salaries, then that's fine. You would model the fact in that you're going to move that money aside, but you've still got access to that cash at some stage.
I think it comes down to, and it was that earlier question about what's included. Like, if you've got 5 bank accounts, what do you include in the opening bank balance? Is it all 5 accounts? Is it 1 account? Is it 3 accounts? There is no right or wrong answer. It's what is going to work for you. Some people might just want to forecast their operating account. So using the example of the savings, if you're just doing your operating account, I would be adding under overheads or money out a new line called transfers out, and it'll be you're forecasting the money coming out of the account, which is going to go to another bank account that is in the business but isn't part of the cash flow forecast.
Nice. Yeah, like Phil says, just do it so that it makes sense to you. Righto. Let's carry on. So those two. Now, there's some tools that you can get online as well, and these seem to be some of the most popular ones, and they sync with a different accounting providers. So obviously we've spoken about Xero, MYOB. They've got their own tools inside them, but they may be limited. So you don't want to just rely on those, because they may not be everything. Now, they might miss PAYE payments or GST payments or income tax payments as well, because they may not know what your tax payments are. Just back to savings, would the transfers not be recorded as an expense? Well, when you're saving money, it's not, to accountants, it's not an expense because it's not a tax deductible expense. So when we're talking about expenses, we're talking about your operating expenses. But in terms of cash flow, if you were saving money and moving it aside, so either pulling it out of the business and keeping it in a savings account or having it in a business savings account, yes, it would be a transfer of the money out. So you could put it in there somewhere. Now, some of these other ones, float seems to be popular with the creatives, and it's expensive-ish, but if it works for you, it works for you, and perhaps it's a good investment into your business, but you can model potential projects that you may get, and you can kind of toggle them on and off of whether you're going to get it and what's that going to do to cash. Fathom is another one as well. And then Hello Cashflow is one we've included. This is a New Zealand startup, we believe, and built by a business owner frustrated by cash flow. And so they've built something that works for them. But what this basically shows you is that we've shown you 2 templates. Now we'll show you 5 different logos of companies that are all trying to solve the same problem. If there was only one way to do cash flow, you wouldn't need all of this stuff because there would just be one way to do it. So that's part of the learning for you tonight too, is that you've got to pick something that works for you. You've got to do the work to get it accurate. You've got to understand it, and then you need to refine it, and you want to stick with it. Yes, there will always be a cooler solution. Yes, there'll be a business owner that does it a different way, but you need to figure out what's going to work for you and spend the time to make sure that you understand it.
There was a question earlier, which has just sprung to mind around 3-way forecasting with the profit and loss balance sheet and a cash flow statement. We're not going into that level of detail in this webinar. That what I would suggest is you'd need to use a piece of software like Fathom or Spotlight Reporting, which do 3-way forecasting.
Michael's asked a good question. Shouldn't you do the forecast inclusive of GST because that is the actual cash coming in and GST may not be due until later? Yes, but you can do it exclusive as well. It really is up to you, but you just have to understand the GST piece. So you could do it inclusive, and then you would have an inclusive income plus GST, same with your expenses, and then you would model the GST payments going out. Some people just prefer to do it exclusive and then account for the one GST payment that's to go, but then basically not model the fact that there's any GST payments.
The piece I'd add there is, Michael, yes, typically, absolutely, cash flow forecast is GST inclusive. But the challenge with the majority of business owners is just the lack of education and understanding around accounting, tax, and numbers. And to be able to not only get somebody to forecast cash in the first instance, which is already a challenge, but then secondly, work out what the GST impact of that forecast would be, and then on top of that, know when the due dates all are.
Yeah,
there's a lot of layers there for business owners, and I come back to the point: near enough's good enough. And if deciding whether it's got to be GST or inclusive or exclusive, GST inclusive or exclusive is a barrier for a business owner, come back to the principle: keep it simple. If it's simple enough for you to do it GST exclusive, and you've got an idea about where cash flow is tracking, that's perfectly fine.
Yeah, and just for some comfort on that too, we've sent cash flow forecasts to banks who have requested them exclusive and inclusive, and the clients have got the lending approved. So again, it just shows you that the practical use of it, if that person, the user, can understand it, it's still fit for purpose. Right, let's carry on. So some things to watch out for, and we've touched on some of these. So exactly what we're just talking about. Are you completing it exclusive or inclusive? Are you accounting for your tax payments? That's usually the thing that gets missed.
On the tax payments, we've got so many people that are part of this webinar, and it's really interactive so far, which is great. And provisional tax has come up a fair bit. The provisional tax dates haven't changed for I don't know how many years. When they did change last time, it was a headache, but the dates don't change. It's the 28th of August, it's the 15th of January, and it's the 7th of May. As business owners, you've got to remember those dates. I think for a business owner, it's got to be non-negotiable that you know when provisional tax is due. So the 28th of August is the first installment, the 15th of January is the second installment, and the 7th of May is the final installment, which is after balance date. for the tax year. I'm not going to get into what happens if it falls onto a public holiday or a weekend. Just remember those dates, the 28th, the 15th, and the 7th.
Nice. And we've done podcasts on those. We've also done a YouTube tutorial about provisional tax. So you can go and listen to some real client examples of ProvTax to better understand it. Don't forget your opening bank balance and what other cash reserves you've got sitting there. Remember that loans coming in, that's money in as well. And then asset purchases, that's money going out. So you want to model that. Depreciation and non-cash expenses are not included. So depreciation, which is the expense reflecting an asset decreasing in value, that goes into a profit and loss statement because it's an expense and it's claimable and tax deductible, but it's not a cash expense. So therefore, it doesn't go into a cash flow.
Smart.
Not bad. Set a calendar reminder to come back and update it monthly, maybe even weekly for some of you, or until you get on top of your cash flow pressures, but continue to do this. This is a very tricky time of the year as well, and we're always warning our clients and people who listen to the podcast nice and early because you've got provisional tax, you've got GST, and you've got PAYE, and they all fall in January. So on the 15th of January, as Phil said before, installment 2 of provisional tax, there's GST to pay, and then there's PAYE on the 20th. Now, often it can be hard to collect cash at this time of year because Roger dodges us and heads down to the beach and he forgets to pay his invoice and he says to you, oh, sorry, Sean's out of the office now. He's gone down to Whangamata. And all of a sudden, you're not going to get your bloody invoices paid that you were relying on in order to pay some of that provisional tax. So be mindful because your staff are still going to want to get paid if you have to pay that out. But be mindful of people switching off and being cheeky around Christmas time and going, oh, yeah, we'll sort that in the new year when I head back into the office. It's a tactic and it could be bad at the moment with just how the economy is going. So if you're relying on cash that you need in January and even February, don't slip on chasing up people who haven't paid you.
And just sorry, on that, when you're forecasting the cash coming in, the other place to look is your accounts receivable age trial balance, I think is the report. I don't know what it's exactly called in Xero. At MYOB, we'll use, there it is, the age receivable summary. So this is the list of all the people that owe you money and whether their invoice that they owe you is current or overdue. You know, if I would be looking at this as part of preparing a cash flow forecast, and depending on the size of the business will depend on how sophisticated you want to be. But I know for some clients that we work with, we'd look at this and would go, right, well, we know that $11,500 is due next month. We're not going to bank on all of that coming in. We might think, oh, well, we'll get $9,500 of that. And we'll just go on the conservative side. But it comes down to understanding your business. You might know that all of your customers, they're on direct debit or go cardless or whatever the system is, and you'll get all of that $11,500. Comes back to the same principle, near enough's good enough, just get started.
Yeah, nice. And it could be, for some clients, they might have a big reliance on one client at a specific time of the year. And we'll say to them, what's the risk that Ridgeway don't pay their $6,000? Because that's the $6,000 that could make or break that bank balance going into overdraft. And you don't want to not have an overdraft or access to some cash and Ridgeway don't pay, and then you've got to ring the bank or you've got to try and find a solution. You want to be thinking about that ahead of time of like, okay, well, if I actually only get 5 of this because the 6 isn't going to get paid by Ridgeway, what's that going to mean for my cash flow because I've still got my expenses going out? So that's the point of doing these sorts of exercises. You start to learn more as you go and start to think about little things like that as well. Now, just quickly as well, profit versus cash. We've sort of explained that a bit tonight, but these two things are very different. You know, cash is what you've got in the bank account. It's what's coming in. It's what's going out. Profit, revenue, less expenses. This is what you pay tax on, but you might not have collected it yet. So you're going to be wondering, well, where is that cash? Because business owners often say to us, what do you mean? How am I profitable? Where's the money? I don't have anything to show for it. And it can often be tied up in debtors, just like we saw before. So we might have invoiced Ridgeway and the rest of the crew for some work that we've done, So they owe us that money, but we haven't physically received it yet. So that means that we haven't seen that cash yet. That could be in paying taxes. It could be in you taking drawings out of the business, paying down debt, buying assets, and those sorts of things. And then, as we said before, depreciation, now that is an expense that will show up in your profit and loss, but doesn't need to show up in your cash flow. So putting cash aside for GST and tax as you go will help you stay on top of all of this. And we'll show you how in a second. What's your opinion on the provisional tax on with GST return and zero? Is that based on your actuals for the period?
Amanda, so my gut there would say it depends on what GST registration basis you're on. GST registration, whether you're using invoice payments or ratio or AIM.
Oh, yeah.
If you're using AIM, it would be based on your actuals. If provisional tax is pulling through just on the standard 3 installment dates, it'll be on the standard uplift, presumably. But my opinion is what you've asked for. I would be using or relying on what Xero's saying for what you should be paying for provisional tax. Your accountant should be advising you what your options are and whether there's any risk of over or underpayment, because it's a cash flow decision.
Yeah, and just remember too that the way that we do things won't be the way that your accountant may do things, nor the next accountant, nor the next webinar you watch, etc. So again, this is general information designed to help you start to figure out how you want to go about doing some of these things. Right, knowing your numbers. So a few things in here, like knowing about your break-even point. So that's things around understanding when are you actually profitable, what expenses do you have that you need to cover. Bottom-up analysis, that's something you can Google and have a look at. It's trying to work out how to target a profit, and then with the margins and the expenses you have, what do you need to sell in order to be able to achieve that. I did a very quick calculation of that with somebody today who was trying to work out how much they would need to sell in order to build the life that they want. Now, understanding the difference between margin and markup, these are some of the additional things you might want to get into and understand. Methodology for dealing with the bank, making sure that information is accurate before it goes to them and not just willy-nilly sending reports out of your Xero because they might not be accurate, and getting the most out of your accounting software and understanding financial reports. All of those things tie into this, but they're not the key part of tonight, but they're just things to think about.
I would just touch on that break-even point. I think that's one number that every business owner should understand what break-even is. And so in other words, you know, what are your fixed monthly outgoings in terms of costs and debt repayments and that kind of stuff, and therefore what is the minimum level of sales that you need to make in order to break even and cover all of your outgoings. That's not going to cover profit, but if you then know that you need to be hitting $50, $100, $150,000 a month, whatever the number is, then you know you'll have at least some comfort that great, if we're billing consistently 200 grand a month and our break even points 180, you've got 20 grand of headroom every month. Happy days. Just those questions. Rich, which software do you recommend for cash to profit reconciliation on a monthly or yearly basis? You would be the first person that has ever asked that. I would use Excel just because I'm a nerd. I'm not aware of any software that would actually do that, but I suspect Fathom and Spotlight do it.
Right.
And then that second one, I assume that if profit's up and you underpay by mistake, what are the repercussions? Provisional tax? It depends. Talk to your accountant and they'll be able to give you the right advice.
Yeah, Napiki, you've asked a number of questions about ProvTax. Now, this isn't specifically covering ProvTax, but I feel like you might need some support from your accountant to, because it's very hard to give specific advice to you that you might misinterpret because we don't actually understand everything that's going on. So you don't want to get that stuff wrong. But very high level, if you underpay provisional tax, you can be exposed to interest and penalties. Right, so some tactics and tips to stay on top of some of these things. This is one of the simplest things that we always seem to come across with business owners who haven't been taught about Xero, that you can actually preview how much GST you have at any single period. Now, I spoke to a business owner today, and they've had their business for a number of years. Their accountants always dealt with their numbers. They've never once been inside Xero or MYOB to look at their numbers. And so they get a fright every GST period because their accountant says, here's how much GST you've got to pay. Now, how we try and teach our clients is basically at any time they can go into Xero and they can work out, right, what is my exposure to GST? Now, in this demo company, we can't show you, but this is how you do it. So you go to accounting, GST return, and there's a little function once this is set up and it says preview period so far. And that will have tracked all of the transactions that you've reconciled in this period, and it will tell you how much GST you've got to pay for this period. Now, it's constantly changing based on how many transactions you reconcile, but we encourage our clients to put that GST money aside as they go, as I think Abby and a couple of others have mentioned tonight, so that they can then lean on that GST account to pay that GST. So this is something that we do. This is something we teach our clients to do. This is something that should be common practice within businesses around the country, especially if you're using a Xero or an MYOB. The whole reason they built these platforms was to give us real-time, up-to-date, day-to-day data. But businesses are being let down when they're being told, hey, you've got 20 grand of GST to pay and it's due in 3 days. You know, you would have been able to know that probably 28 or 25 days earlier.
Yeah.
Because the data's been sitting there the whole time, but no one's taught you how to go and find that. So let me know in here. Yeah, there we go. 6 years in Xero and didn't know that. Thank you for the tip. So that's again, write that one down for Ren. That could completely change your understanding of cash just through that one simple tip. So if you don't know that, then now you do.
The other point I would add is when you're doing this, it's only calculating the GST based on the reconciled transactions in Xero. So if your bank rec isn't up to date, that GST return isn't going to be accurate.
And if you get your coding wrong, it might not be accurate too. So as an example, what happens is people buy a vehicle or a tractor for their business, right? And they see they don't pay for the whole thing. They get a loan and they pay the first UDC payment and they go, oh yeah, that was to motor vehicles because I brought a motor vehicle. Well, actually you should be probably maybe, that's good. Check with your accountant, but you might be financing that. So you want to capitalize the entire asset, record the $30,000 transaction, claim the GST on that, and then reflect the UDC payments against the loan. So that's where you do need to know a little bit more about this stuff to make sure you're getting it right.
Those last two questions there are somewhat similar.
And I've got the answers in the next slides. So
yeah, that's right, you do too.
We'll get to these because basically people are saying, what do we put aside for GST? What's a popular way to do it? Now we've actually got another webinar here or a full training of just a screen record of how to go about this if you want to. But I can summarize it for you in 2 slides. Basically, this is what a lot of people do. They have cash come in and it goes into a business bank account. Now, if you want to be exemplary, this is what very few people do. So walk you through an example. Say they invoice $10,000 plus GST and they get paid that. They get the $11,500 into their business bank account. So that's account number A. And then they move aside the $1,500 of the GST into account number B, and then they move $2,000 as well. So that's just a 20% buffer for eventual taxes, and that leaves them with some business expenses that they can pay from the remaining money, and then they might put between 1% to 3% into what we call a shit hits the fan account, so that you're building up a cash buffer should you need to lean on that at some stage. Now you can model that or you can change that. Even just simply putting the GST aside and then a little bit for tax, that can be very helpful as well. But as with anything, it's going to depend business to business because you might not have a highly profitable business. So you might be saying, well, why are we going to put 20% of that $10,000 after that's 11.5 after GST is 10? why are we putting $2,000 aside if we've got heaps of expenses? So it does pay to understand, but this is a very simple way that we've been able to explain to new business owners, hey, if you follow this, you should have put enough aside for taxes and GST, because when your GST comes due, you'll use the money that's sitting in that GST and tax account. When your provisional tax becomes due as well, then you'll use the money sitting in that too. Now, as you become more profitable and you start going past $100,000 of profit in a year and whatnot, that 20% might not cut it, and it might need to increase, but it really depends on the profitability of your business.
I think the point here as well is this is a guide and it illustrates a principle that the ratios or the percentages are going to differ from business to business. One of the earlier questions, do you put aside 15%? It could be less because you might have more expenses, who knows? Or your expenses might actually be a whole heap of wages, which have got no GST. The other one, they're popular ways to keep GST aside as the month progresses. As a renowned for saying on our podcast, newsflash, no one does. And this is why we come back to the odd person. There's actually very few businesses that have a separate GST account. And I don't think there's any popular way, but the simplest way is to go back, and if you're using Xero, preview the period so far. And to illustrate for us, maybe it's because we're nerds and numbers are just what we're familiar with, but that preview period GST function, we check that twice a month, and we know to within probably the nearest $1,000 or $2,000 what our GST liability is at any point in the 2-month period, and we've got the exact amount of cash set aside in a separate GST account.
And then the same thing with taxes as well as you go. So if you're using the likes of Xero, this is very easy and this will work well for you. If you're using a spreadsheet, that can be a bit trickier, but you could apply the same methodology, because you're going to be able to remember, for some of you, after you're a bit newer to it, but you have your revenue, which is after GST, then you have your expenses, which are after GST. Revenue minus expenses equals profit, and eventually you'll pay tax on that profit. It'll either end up under your own name or maybe in your company. But if you're not putting money aside for those things like tax, then you're going to get a fright at some stage.
Jess, do you recommend using a software program for cash flow forecasting, or Excel spreadsheet is fine?
Does Jess just turned up to the webinar? What happened in the first half an hour?
Excel's fine. Hey, look, even just doing it on the back of a piece of paper, so the point of this is just get started. Excel is completely fine. Personally, I don't see any need to pay for the likes of Fathom or Float or any of those, because a spreadsheet is, if you keep it up to date, just good enough. The beauty about having a software program or an app is you can have some level of integration back to your accounting software, whether it's Xero or MYOB, that might make things easier. But yeah, I think once Excel or whatever Google Sheets is set up, so long as you keep updating it regularly, it should be a pretty straightforward process.
Nice. As we're still on the old tactics and tips, there's some ways to speed up money flow through your business. We've done entire pods on this. We could talk about this for hours, but thinking about the terms. So what are the terms of your business and how did you come up with them? Are you just copying what somebody else does in your industry? Could you be charging up front? Could you be taking a deposit up front? Could you be billing 7 days after completion, rather than saying, oh, just pay us, on the 20th of the following month? We know that's not applicable for every industry, but for a lot of them, things have changed, and you might want to offer a discount if you pay, if they pay up front, and you collect the money so that you can bank some of that and protect your own cash flow, but you deliver the service over 6 months or beyond, for instance. These things are all for you to decide, not for, oh, well, John works in my industry and he said that this is how it has to be done. Business is about building it on your terms and being strong enough that you can go out there and fight for those, and also win enough work that you don't get pushed around by people. But yes, easier said than done, and sometimes not applicable for some of those bigger industries where there are bullies that just go, nah, this is how we work. If you don't like it, see you later. Debtors, what's your process for this? So that's accounts receivable. That's people who owe you money. How are you going to chase up unpaid payments? Do you have a process for that? If not, why not? Can you use ChatGPT to write you some reminders to send to them? What's your final point where you say to them, right, this is going to go to my debt collection service, for instance? You might not even have one of those, but that could be enough to frighten them into doing it. Can you take payment via Stripe, for instance? I just paid for something for someone who I know is on this webinar, and I'm fairly sure they were probably using Stripe. There is Go Cardless available for direct debit as well these days, and you'll be surprised how many businesses are actually using direct debit. I invested some money yesterday through Milford, I think it was, and one of their options was direct debit, and it was an on-screen tick this box. You've given us permission to direct debit from our account, and I saw this morning the money was gone. So stop thinking that these solutions are just for the big boys, and that doesn't work for me. There's a reason that these big organizations are turning to these tech solutions, because they want to get a hold of the money faster. They don't want me to then go, oh, I don't know, should I invest that money with them? Or might think about it overnight. I haven't done that bank transfer yet. They're like, no, come on, you're here, send us the cash. And so they're providing the solution to do that. 3 very important and quick lessons when it comes to money. It's not always what you make. So everyone loves to talk about the revenue and things like that, but it's actually what you keep, to then be able to invest into your business or into yourself, to pay down debt, to store for ammo. And people got excited during the pandemic about talking how much their revenue had grown and whatnot. And we were saying to clients, cool, what are you going to do with the cash that's left after paying tax at the end of it? And the classic one we always see, business owners have one good month in business and they spend like they've had a good year in business, and they're off to the car yard, they've got the boat, whatever. Just be careful about how overconfident you get about a good month in business. Your target is to invest more, not just to make more, because you'll end up probably matching your expenses with your income. So be very deliberate as you collect more money and make more money. What are you going to do with that? Think about it ahead of time. And those are good problems to have. And remember too that there's a lot of doom and gloom out there at the moment, and it's hard in business, and we're all being told that, and there's heaps of data to back that up. But as a business owner, you can control your total income and your destiny. Now, I spent 40 minutes on the phone today speaking to a business owner about how can they get hungrier, what do they need to focus on. They've got data to suggest that they know what they're doing. How can we do more of what's worked in the past and less of all these things on the fringes that are just keeping us busy but not leading to any income? Being in business, if you can get it right, is a great way to weather economic storms, because you can control your income, but you have to know how to do that, but you can learn those things. Then as we begin to wrap up, so what are you going to do with the money? You might be drawing it out personally, paying down mortgages or investing, and you might be paying down business debt. So these are just these are some of the ways that you will that money will disappear as such from your business. And clients will sometimes say, well, where's it all gone? You might invest it. It might be tied up in stock. You might want to spend it on marketing or staff, and then know that there's a lag to then get that money back in the future. You might be buying assets for the future and tying up cash in that. You might be building up a war chest. So just start to learn, like, where is the money sitting in your business as well. Now, here's an example from somebody who's saying that they've taken some action. So Go Cardless changed my business and gave me more control over cash flow and accounts receivable. So this business owners are doing it out there. Don't be scared to take some action. Right, we'd love to know from you from tonight. We've gone past the hour, but what 3 actions have you written down that you can get to after finishing this webinar tonight and potentially coming back and checking out some of the different things? Alice has got, check my GST in Xero. Good stuff. Check ProvTax dollars. Nice. And it could be 1 or 2 things, but hopefully you've been taking some notes and writing down some actions that you can take. Use the spreadsheet. Go back to Excel. Nice one. Keep it simple. Make a forecast for Ren, number 1. Keep it simple. Check P&L and GST and Xero. Use a spreadsheet. Nice. Yeah, I think we as accountants overcomplicate cash flow, and we confuse people with what it all means. Fill out more in-depth cash flow, change terms to 7 days and set up Go Cardless. Nice one. Do 3-month cash flow prediction and do monthly plus figure out my exact break-even point, get some payment terms and follow-up processes sorted, double check my break-even, update my transactions for profit and loss. Nice. There's some very clear things that people have got. Shit, it's the fan account. Now good, 100%. Was going to set up a account which is for a defects construction company and bonuses if not spent on defects. Nice work. Use spreadsheet, add reminders to check P&L and binge old podcasts. Good stuff. You can also search on the podcast. We've got over 350 now, so there's a fair few there. But if you search, for instance, in the show, you search provisional tax, it'll pop up with the ones we've specifically titled them around provisional tax. GST, LOC and Xero, find your accountant. Work out latest break-even, understand bottom-up analysis. Nice, awesome. Well done. Not many people pick up on that one.
I just add, has anyone got any final questions just as we wrap this up that they want to sneak in? We'll give it a minute or so.
We're happy to stick around for a bit. If you are jumping off at the moment, we'd love if you could leave a Google review. That would mean a lot to us if you've gotten and you've learned something out of this. So nice to be here with other business owners. Thanks. Let us know as well, is that meaningful for you guys to be able to spend time with other business owners? Because we've got some ideas around that in the future as well. And like to be able to facilitate that because that's how people seem to learn the best as well. So any questions, feel free to let us know. And if you could leave a Google review for us, that would be amazing. That's all we ask after tuning up to this tonight if you've learned something. So search for Next Advisory, should be able to leave a Google review for us. This has been great. Thanks so much. Learned so much. Thanks for taking the time to share. Legends. Thanks. We'll release this replay as well. And we'll also release the audio so you can go back and listen to the audio at some stage too as a podcast. When changing terms that affect your customers, is there a specific time you need to give warning? Not really, but it's just usually about doing the right thing.
Yeah, I'd be wanting to know, do you have existing terms? And if there are, is it covered in any existing terms where there's a notice period or something?
Yeah, maybe you've got something in your terms already that says that you need to give the notice, but we find that as long as you communicate proactively, most business owners are pretty good about it. Thanks for the cash flow spreadsheet. Thanks, very helpful. I'm just learning it all and trying to help my husband with his business and finance and accounts and Xero. Good stuff. Thank you so much. Thanks so much. Learned lots. Thank you. Wow. Learned I'm on the track doing the right thing. Good stuff. That's the way. Brilliant. That's what we like to hear. Awesome. Well, if you are stuck and you need to get in touch, then you can do that via our website. You've no doubt heard us talking about that before. Happy to have a chat and see if we can point you in the right direction. But that's not what tonight's been about. It's been about helping you guys understand what it is that you can be doing to start getting on top of understanding cash flow. And interestingly, we saw a stat this week where it was talking about the high percentage of businesses in New Zealand that are stressed about money. Now, one of the least common tactics that people took to get on top of this at 7% was reaching out for help. We thought, fuck, shouldn't that be number one? But number one was basically, I think it was setting up some of their accounts on
automatic payments,
for their bills, and we're thinking that's not necessarily just cash. That's not going to fix everything. So it is important to reach out for help if you need it, and don't let your ego get in the way of that. We love spending some time and talking with other business owners if there are future events. Appreciate it. Awesome. Listening to you guys always leaves me hyped up for future business. How good. Cheers. I love to see business owners winning because it's not easy. That's one of our values, winning. We like to see business owners winning too. Thanks, guys. Really appreciate it. Not a problem at all. Thank you so much for coming along tonight. There are some resources there. It's good to see Ngāpuki's feeling empowered. That's what we like. We'll get these cash flow templates out for those people who are watching this as a replay. If this is now on YouTube, they'll be underneath here as well. But if there's anything that you've missed, feel free to get in touch. Check out some of our other resources. Again, if you could leave a Google review for us, that would mean a lot. And look after yourselves, and we'll see you on the next webinar. And if you've got any feedback of what those could be, then yeah, feel free to let us know. You should get some questions to answer when you leave and jump off of this call. So I'll chuck us on mute, and we'll see you next time. Enjoy the rest of your night.
Thank you.